And here we are. Good morning, everyone. Thanks for being here. Kind of interesting times we have. I'm just going through some of the comments, and I know everyone's excited. We're going to get rocking and rolling here. First off, in the document tab, you can see the document tab where what I do in this room. For you that don't know, you can go down. I've already clicked on the link. I will do it again, though. Today is, if I'm not mistaken, the 14th, all day long. All right, so you can either go to the Documents tab, as I just shared, and then scroll down. You can find every single day, for the most part, every single day, we put out our trading thoughts and sheets, and today's no different. Basically, what I wanted to cover, you guys, there's for the first time in 5 years, I've been increasingly bearish, and I think you can read all this stuff in here. It covers a lot of stocks. There's just, I guess, what it boils down to, there's too many stocks and sectors appear to be a little top heavy on a longer term perspective. And if I can get this out of here, we just start taking a look top-down approach. This is obviously the S&Ps. This is a daily chart from the year. You can see we've been almost in a perfect channeling. I mean, we dropped through what my style of trend line analysis is not to draw on the exact low. I mean, they're arbitrary. I like to look at the average lows. We've been hovering against a longer-term resistance chart over time. And we're now just starting to see, if you can take a gander down here at the bottom of your screen, this is the an advanced decline comparative ratio line exclusive to just the S&Ps. As the pricing is making, or as the index itself is making newer highs, we're starting to see a divergence within the AD line. So that's a cautionary warning sign. Obviously, we've seen, and everyone's probably fed up of hearing about the Russell, the small cap, but quite frankly, we did make a newer high on a closing basis by just a few ticks here. Volume was lighter, a little divergence there on OBV, and again, we had a lighter reading in the advanced decline on the Russell 2000. That's the AD line just on the Russell 2000. The Qs, which back in May and April, late April, early May, we were bullish on the Qs, or in the technology space, and I think it's now getting a bit overplayed, both the AD line from just a very small one-day correction. We came back, and then note Friday, we're pretty close to where we ended the highs on the Qs, and yet the AD line didn't come back that strongly. So we'll give it a little chance. Moral of the story, for a long time now, long being 4 months, I was looking for strength headed into July, approximately the third week of July. This is the third week of July. So from a cyclical standpoint, I was looking for a top formation to occur from cycle analysis. Now, cycle analysis is great. It's great when it works, and it's not great when it doesn't work. So I mean, just like any form of technical analysis, whether it's Elliott wave, Fibonacci, whatever you're using, it's all great when it works. It's fabulous to be able to outshine and say, hey, I predicted the top of the market. I think that it's best to use cycle analysis as a cautionary warning first, and then use other technical indicators to confirm. And so that's what my message is here. So I just see, when I look at the technology space and I hear everyone's, saying now's the time to get into large cap tech stuff, Microsoft, Intel, things of that nature. Now, back in May or April, a lot of, acclaimed forecasting technicians were claiming that the market was going to crash and burn. And now those same technicians are saying you got to get long this sector. I look at the NASDAQ Composite Index, and I look at the daily charts on this, and I go, interesting, these are daily charts now. and I go, wow, the advanced decline, while we have made significant higher highs, we've kind of weakened the advanced decline in the NASDAQ composite, not the Qs, the composite index. So that's kind of another warning shot. So I've got, on this board, I've got the fact that the S&Ps are near a longer term resistance, which means we could shoot up. Okay, so I'm gonna believe it or not, some people have asked if I would record this, and I didn't. We'll do it now, and then we'll just jump right through it. PNS, what's today? 7/14/2014. Wow, that's kind of like a numerology type of day, right? 7, 2 times 7 is 14. It's the 14th day of the 14th year of the new millennium. Wow. Well, I'm welcome, everyone. A numerology day. So anyway, here we go. Looking at the market today for the week of 7/14, we have an interesting situation, and the situation is we have a timing event that I've looked forward to since about the late April, early May time period, and we're looking for a cycle high due this week. So in my longer term analysis, we potentially could see a blow off top, or we could see the market, if it is a cycle high, we could see the market at least come back and test this upper boundary of this longer term trend line. And if you note where we could be on a weekly basis, we could take out the highs, be up in here, but I believe that at this point in time, everyone needs to heighten their awareness that the fact we're starting to see some divergences in market internals, not just in the one index that everyone gauges their market internals off of. Many traders and indicators, the ARMS index, the TRIN, a lot of educators all look at market internals based on the NYSE. I don't gauge, in fact, a lot of popular, very important trading platforms. If you look at their advanced decline, it's on the NYSE Composite Index. Great broad-based index, unfortunately, contains a lot of interest rate sensitive products, and so therefore you could get a false reading. But nonetheless, people do look at the NYSE. I like to look at, if I'm trading the S&Ps, if I'm looking at the Qs, if I'm looking at the diamonds, the Russell, the NASDAQ Composite Index, and the NYSE, I look at market internals on all of these various sectors. And so, you know, it may be confusing, but it gives me a better gauge of the broader sense of the market. In a term broad, you can't get much broader than looking at all top 6 indexes. So with that said, what am the moral of the story? This week, I'm looking for a potential blow-off top in the market. The Russell continues to, if it does have a rally up in here, I think we need to respect the fact that last week, not only did we form I guess you want to call that I mean, that's a goalpost double top right there, right? And first and foremost, we want to say congratulations to Germany. What a win, right? The World Cup. I mean, I know Americans are more baseball, football, soccer, lacrosse, hockey. I mean, they'll watch any sport before they watch soccer, but that really was an exciting event, especially as, you know, since the U.S. did lose to Germany, Germany won the World Cup. It makes it feel kind of good. Our goalie was sensational against their shooters, and quite frankly, it was, let's not take anything back from the Germans. They played clean, they played great, and boy, they were outstanding. So with that said, you know, I thought it would be apropos to kind of say, boy, how did they do it? Well, they did a lot of teamwork by passing, and they did it one kick at a time, literally, and they did it one goal. So they did it one kick at a time, and they got it to the champion and won the World Cup. So anyway, we should give them congratulations. They showed just what you want to see in a professional team. Sportsmanlike conduct. They weren't dirty. They didn't. They passed. They were team players, and they did it one kick at a time. So in any event, how do we do our market analysis? One trade at a time. That's about the bottom line. That's how you do your trading, one trade at a time. I'm looking at a weekly chart here of the Russell, and the weekly chart looking at the AD lines suggests that while last week we had an amazing, what we would call, not quite an engulfing pattern of this week, but we did close below the lows of the last 4 weeks, or the average of the last. If you include this low and that low, you add up all these lows, we closed below the average of all those lows. We also formed a pattern that we've acknowledged as the low close doji. And basically, you close below the low of this doji. Now, when we get this type of a severe decline, like, for example, over here, typically you may find the market to rally back a bit. And I am looking for the market because I think it was a little bit overdone and it didn't join the other indices. So we are looking for the Russell, as measured by the IWM, to possibly rally up. Maybe we can get back up into the 118.40 or something of that nature. What we want to watch for this week, though, if you look over here, you note that, for example, the market generates a weekly sell signal, but it generated a weekly sell signal when the advanced decline rose. Do you see that little anomaly? The yellow line down here from this week to that week, prices were down, but the advanced decline was up. So you'd probably be wondering, yeah, what the heck's that all about? Well, that was suggesting that not all stocks were going down. They were actually accumulating positions. And then what we saw was the very next week, the market did what we call an equal yet opposite. So in other words, it was equal in color and opposite in direction. We had a red candle, meaning the market closed below the open, and the very next week we kind of opened a little higher and closed higher. It was an equal and greater, as what I classify that as. So what's the difference between watching for that situation? Well, this week we've got to be on guard that let's see if the market's going to open higher. We know that. And we got to watch by Friday if we form one of those equal and yet opposites. The fact that we have a different construction of the advanced decline in the fact that, unlike over here, this week we did do some I'd say not destruction, but we did see deterioration, for a better word. We saw deterioration in the AD lines in the Russell. So the fact is that if we get a rally here, you want to watch for a push to the upside. And I think right now it does, if any time you've ever heard me, now is a time to put out a cautionary word on any further strength to the upside in the market. When I look at specific stocks and my momentum longer term, and I mean, I think it might behoove us to look at some longer term monthly charts in this situation, and rather than daily charts, which most retail speculators and even so-called, I think a lot of people just look more at the daily, maybe the weekly. Very few look at monthly. And one of the things that you got to recognize is that when you look at the longer term chart, you can say, what's the duration of the chart? What's the trend been? How long has prices moved? So you get a kind of a better feel of not only duration, time, but also price. And then you can start to look at, well, what does the market look longer term? We had a long shadow over here, and this is CMG, by the way, and now the market's trying to push up, and then you'd say, well, what's this indicator down here? This is a momentum indicator. It's a proprietary indicator. As prices have been pushing up, the momentum indicator is showing divergence. This is Chipotle Mexican Grill. It's showing a lot of warning here that the market's losing its bullish momentum and it's running out of steam. This is McDonald's. It's in the same space. And as you can see, while we don't have a newer high, we are seeing a push lower in momentum. So over and over and over again, I can look at Ford Motor with you real quick here, just to go on a different note here. And Ford Motor, as we have seen a breakout, it looks great, but everyone may forget that back here in early 2011, right, we were up at this level. So we are forming kind of close to a resistance. So what I would say is, while we might have some more, a little more upside in markets, the monthly charts are showing that we're kind of running out of steam, and it's getting a little tired. So you want to be a little careful. The fact is that people that are looking at some of the technology names. And this week we have a big week in the sense that we have earnings, we have all kinds of things coming out. But I find it interesting that people all of a sudden want to buy a company like Intel, Microsoft, the large cap tech names. So let's take a look at Intel real quick. You know, from a monthly perspective, yes, granted, we broke out above this high. It's been something that we've, a lot of technicians have been looking for, but we also note that, you know, maybe we could get up into the 32, 33 handle up in here. And so I would be very concerned that the fact that while we've had an ABC measured D wave, right, we've seen this market since the '09 low try to move up, and now it is, and now people are getting bullish at this point in time. I would have to say that while you might have a 3 to 5% upside, I think you got about a 15 to 20% downside. So you guys traders have to look at the math there and say, is if I couldn't get in on a low closed doji way over here in the beginning of 2013, or look at this pennant breakout, and now people are telling me to buy Microsoft at 42, God bless them. But even the longer term momentum indicator is starting to show, and I don't, even if you don't understand what this is, don't ask what it is. It's not going to be disclosed, but just you could probably see that more or less as the market moves up, this indicator is not making higher highs. So at the very least, maybe you could throw up any other indicator on a longer term monthly chart as a hint for you guys to say, gee, is now the time to be looking at this. While I don't have a short-term trigger to go short, I do have a cautionary flag. And the problem is one of these days we're going to walk in and you're just going to find this stuff sharply lower. So I think it is not just a cause for concern, but now is the time that I think in certain stocks, in certain areas, as we get into earnings season, maybe look as we pass this week, instead of pricing out and picking out the exact stock to move, which is obviously the most profitable way to trade, is to pick the right stock rather than look at the overall sector or the overall index, in the sense that if you get a 5 or 10% move in a stock, you might get a 1 or 1.5% move in an overall index. So from a percentage price move, it's better to, you know, be a stock picker and to pick the right direction. Microsoft, may I add, is also coming close to a major pivot resistance target area. So I'm picking on the technology space because, number one, it does actually lose its seasonal strength in the month of July. When I look at names like a Monsanto, which just a few days ago, if many of you guys might want to see, and this is just the case in point, Monsanto was looking, it gapped higher, and everyone was looking at this thing, and it just sounded great, and it was just a darling, and I know they covered it, and all of a sudden this thing, you know, has just gone from a peak of close to 120, a little over 129 to 120. We started to lose a little bit of the bullish momentum in this stock. We lost some decent volume in this stock. All of a sudden, we went from how great this stock is to, gee, why didn't we see that one coming? And the moral of the story is this is the kind of thing that as you start to see markets making higher highs. But one thing I want you to focus in on is the fact that while we're making higher highs, you'll note that as we make these higher highs, they're not as high. Each respective new high is not as high as they once were. So the trend is starting to get a little tired here. And as we press on towards this longer term top here, I think that at the very least we can see names, maybe if they did return to trend. Let's define what the trend is, because this is in the sheets that I wrote about our market thoughts and concerns. So if at the very least simple analysis says this is a trend line of resistance and this is a trend line of support, a channel, gosh, we've already hit the top end of this resistance line. There's the parallel resistance line. We hit the top of that. What would happen if we got back down to the bottom of this trend line sometime over here? So you're back down to maybe about 108, 105, something like that. And then we'll see what happens from there. But the moral of the story is I think that this market here is it has been demonstrating some signs of caution up here for the first time. And one of the things that I think, if you do look through here, we had there's so many energy stocks that look dismal. There are just too many stocks to name, but of course Chesapeake was a favorite not long ago. Just there are the names right there. You can take a look at those yourselves. And then all of a sudden in the insurer sector, which is the KIE, you take a look at THG, PGR, and even Allstate. In the materials sector, PX generated a weekly sell signal with bearish stochastics reading. Apparel retailers, Ross, KSS, Limited Brands, which is Victoria's Secret's parent company. You know, then, I mean, I just go through not just a lot of stocks I'm picking on, but sectors, and overall sectors are just looking worse and worse and worse. And so I think last week, I will admit, I did turn CNBC on to just see what the 30-year bond auction was results and how the market was going to respond to that, because we're looking at the knob spread over here. We've been doing knob spreads for decades, but the long and the short of it is I noticed that they had a bunch of wealth advisors still touting that stocks are still best investment choice, and they look lofty, they would stick with, and I quote, large capitalized technology names, and they love the semi-sector and including Intel. They all seem to love Intel. Good for them. So everyone's barreling into Intel now. Wonderful. Be cautious. So I may be so bold as to point out that the semi-sector has been the strongest sector. It's only up 58% in 19 months. The sector itself, 58% in 19 months. So maybe it goes up another 2-3%, but I think we all know that nothing's ever different. Things do change. You know, things do change, and the one thing that is constant is human emotional fear. And I'd say at this point in time, we do have a change in the marketplace. It is different this time, and what the difference is we're reducing quantitative easing. So you know, besides that, bonds have been up, gold has been up, and I'd say one other cautionary word out there. The CFTC commitment to traders data shows in the S&P small speculators are net long now. With commercial slightly longs, hedge funds are short. So you also have to wonder, in a growing economy, as it expands, people buy growth stocks because they're looking for expansion. And so with the weakness in the Russell, I think people are scratching their heads saying, gee, I wonder what's happening, and why isn't this conforming? And then they ignore these signs. And then what happens is you get this delayed reaction. And I'm sure you guys, if you've traded before, things didn't make sense at one point in your trading career, and then weeks later, you're like, oh, now I see. Oh, now it makes sense. Oh God, yeah, there was a delayed reaction. So I think it does warrant some caution in here, and on strength in the segments that I've just mentioned, any further strength, I think it warrants taking some as we get through earnings season, and in the next week to 10 days, which we're going to be on our financial cruise next week with a few of our students. I would definitely be looking, if you're an options strategist, on further strength in the market. I would take into account that, A, you might see any expansion in price premiums, some credit call spreads in some of these top names, especially on any further strength or upside market. One thing that I will note here, if you don't understand what a weekly LCD, that's a low closed doji. So when we take a look at some of the names here, for example, let's take a look at AVY, and you'll get to know this Avery Dennison. I mean, not the greatest, you know, company in the world, but nonetheless, a low closed doji on a weekly basis and a decline in the momentum indicator causes concern. ADT. I mean, we can go on down the list. I'm just going to show these to you. ADT, major for you TTU students, major benchmark, came right into resistance and now not only formed a PPS sell signal, but a low closed doji. I mean, weak stocks that are weak may remain weak. And on any recovery, here's John Deere in the industrial sector. One of the things that, as you can note here, as I may share with you guys real quick, we made newer highs. And if you note my little indicator over here, the momentum indicator was making lower highs, right? So it was warning. Now this is a weekly chart, so it's a little bit more, longer. It should give you the hint that it's a little more longer term duration, that you're going to probably expect further declines. And so we have. So what I'm saying is, I'm seeing not just, this may have passed, of course, the opportunity to sell near the highs, of course, but what I'm sharing with you is that I'm getting a lot of major divergence patterns on weekly basis and on monthly basis up here. Something that I haven't gotten in a long time. Many of you have seen me at various different presentations through the year. This year, for example, some of you guys are like repeat offenders, and so thank you for coming back. I know for a fact, because we record this stuff, we were probably one of the few people that were actually in the bullish camp back in April-May time period rather than bearish. And right now, the funny thing is, I see more people out there saying that the market's still intact and healthy, and I'm seeing stuff that says contrary to that. When I look at a company like even JP Morgan, JPM, and this week we have a lot of earnings out, so do take advantage of this little sheet here. But same thing. Benchmark candle comes up to resistance on a weekly basis, and then we get a low close doji. This is JP Morgan. So perhaps on a weekly basis, and of course Jamie Dimon, and no one ever wants to see CEO like that suffer through such a significant illness that he's going through. But boy, I'll tell you what, remember Wells Fargo? We had Wells Fargo with earnings out, and everyone loved Wells Fargo, and they beat. But here's kind of the results, and as the market was making newer weekly highs, the momentum indicator was stalling. So I'm just warning you, how to look at this sheet is real simple. We have all of these stocks made low close dojis. These stocks not only made low close dojis, but also made a PPS sell signal, and these are not daily triggers, these are weekly triggers. So, all right, not all is bad. Amazon, Costco, JEC, NOC, those made weekly high close dojis. These made weekly PPS buy signals, Safeway and Tyson. So people are going to be buying chicken at their grocery store maybe. Another thing I wanted to teach you about this sheet here is commodity seasonal spreads. This spread is still in effect and can still work. You buy May corn, sell D's corn, and then this spread here, buying D's wheat, selling D's corn, from the 25th, that spread is up about 2 cents. It is still in effect, but we're running out of steam on that one right there, or timing, which ends, by the way, next week when we won't be around. Your reports and events this week, we've got a bunch of stuff. We got option expiration for the monthly options this Friday. We have Janet Yellen speaking both today, Tuesday and Wednesday. So your reports and events are all lined up here. And then earnings. Obviously double check your earnings, but you can see we have JP Morgan out tomorrow. Today we've had already Citi, and then double check these, Rambus, Whirlpool, Schwab, Hertz, etc., etc. Hertz or Heinz, I forget, HTZ, MB Financial, and of course, this week, Abbott Labs, Bank America, PNC. So you got big banks, regional banks, St. Jude's, USB, Yum Brands. eBay comes out Wednesday. eBay, and there's our opening bell. And eBay's coming out this week. And so one of the things that it's interesting that we had Amazon and eBay both up, and eBay was one trade that we picked out in the trading room a couple weeks ago, based on a weekly high close doji. And to me, I think there's possibly some more upside. The negative momentum is still there on a monthly basis. The month is still young, and so I think that we've got possibly a potential run in eBay on a daily chart just to come back up and kind of fill this gap in here around the upper 52s. Volume for eBay in the last week, as we saw a nice little push to the upside, was not all that great, I'm here to tell you. So the rally was not one that I would sink my teeth into. So I think the sheet we could spend all day talking about this sheet. It's designed for the week, but I think you can read through it, and you can take a look at some of these sectors that we talked about. But I think one of the most interesting aspect is the S&Ps showing the COT data and the market being up. And for those, as a quick announcement in conclusion, last week we did a webinar. We offered this. We had several, meaning I think 3 or 4 phone calls that people couldn't find the link. We had this offer, and it because we came into the office and there were these messages here that people couldn't get the link. If you are one of them, may I just remind you, it was our special courses. The link will be down. They are $89. The link is right there in posted if you wanted to take advantage of that. You need that special link. If you don't have that special link, or if you did not find it, you may want to click on that link versus finding out that the trading courses are not $89 every day. In fact, if you go to the store and look at our courses and try to buy the advanced trading course online, it's $489, and that's our pricing for this same course, the advanced traders course. Instead of $489, it's $89. So day traders, you might want to look at that. The advanced trading stock traders, looking at seasonalities with this course, you can actually go and look at all the features that this is an incredible course had to offer, such as what are the last conditional change in the high close, low close, CFTC, all that type of stuff, seasonal patterns. It was a very, I think, a very complete course, and for the price, it's fabulous. So this will come down today, and so for if we had several people that said they had a problem finding it or couldn't get the link, I imagine there might be more out there. I also want to make mention this year we have several events coming up for those that are interested, and we're pretty excited about some of these events. Number one, we've got Trading Mentorship at Sea, and then we will be doing a 2-day seminar event right here in Florida. And this is going to be exciting. So if you're looking to come to have a little R&R, learn some great information here, you have one of our neighbors here, Jeffrey Scott. We're going to have Sonia down here, my wife, everything. You can find out all this information right here and what we're going to be covering. It's going to be really, it's going to be a fabulous event. So we look forward, if you're interested in coming down to Florida, probably the best, most pristine place in all of South Florida, and I know all Floridians say their neighborhoods look great, but boy, up here in Singer Island, North Palm Beach, it is just spectacular, growing by leaps and bounds, and it's actually looking to be an incredible area. So needless to say, I hope you understand, I am starting to look at more bearish option strategies. Momentum is starting to even wane on our, one of the things that I'd have to note, that typically we've seen the market kind of open a little, trade lower first, then trade higher, and today we just kind of traded higher first. The momentum, even on the 15-minute, we're starting to lose this momentum bullish bias. I would look for breaks, as I've done with TradeStation. I will give you guys this insight right now. First off, from a day trade perspective, on the S&Ps. First off, with the S&Ps, we have a very strong upside 60-minute bias. However, we're starting to lose a little bit of that bullish momentum. So I would wait for, obviously we need to see some type of trigger to the downside. Just because we're losing momentum, what it warns us is that while the market's making higher highs, the indicator's making lower highs, so we want to be on guard for a trigger, a sell signal. So with that said, that's up in here, it's sharing to us that we are losing this little upside bullishness. Aggressive traders would look at it maybe a 2-minute or a 5-minute is my preference. But boy, on all time frames, I am showing here that we are losing as prices have stretched up, making new highs. We are losing bullish momentum. Now we just got to wait for a trigger if you're looking for a day trade. All right. So overall, we've covered quite a bit of information here. I think looking at the overall market, this is the week, once again in summary, this is the week that we're looking for a cycle top in the market. I find it as we've moved a little bit higher and opened higher in the Russell. The key is we might be able to get, maybe press this. This is a weekly chart. We could get the market sometime this week up here. We certainly have a lot of events that could get us there. What events are there? Janet Yellen speaking, that's for one. We got the Beige Book out on Wednesday afternoon after she's done speaking. Philadelphia Fed survey is always something that's of interest here. And I'm starting to just position myself from a long to a nimble short position. So one of my techniques that we did several weeks ago, many of you guys were here for that, when we look for a initial position in the marketplace, I do a strategy. Instead of getting all in, I kind of spread it out over time. You enter some positions on like a Monday, you enter some on a Friday, and then you capture like the average price of the range of the week. And that now what I'm looking at is I'm going to be scanning for trades in certain stocks today and tomorrow and this week that I feel are maybe a little overvalued, and we've got to also be, which makes it a little bit tricky in this time frame, because now we got to cross check for earnings. But this, I think, is a great optionable time period for us, especially as we have some stocks in a low implied volatility market compared to their 52-week time period. And so we're just going to be scanning for confirmation on a lot of these names that I've given out. Chipotle Mexican Grill is certainly one that's been on the list. By the way, it's not a great, as many of you already know, it's not a great product for trading options. Directionally, yes. For spreads, no. It's kind of what's the word I'm looking for? Kind of thin, I guess is the way to say it. But I would look at now a couple. If you note on my board here, you'll start to see like TZA. You'll start to see QID. You'll start to see FAZ. So now I'm starting to look at some of these inverse ETFs that how many people on the news have been touting, everyone's talking about getting long the market. I don't know if anyone's talking about, hey, let's get long or start looking for some triggers in some of these inverse ETFs. One interesting note here on my momentum indicator, this is FAZ, it's the Financial Inverse ETF, right? So as prices have made lower lows, clearly you can see that, note that my little histogram indicator is making higher lows. I'm sure you can now see we are coming to almost a convergence situation. What's missing? The trigger to go long. So when that does, FAZ is a consideration, a considerable consideration, especially looking at if interest rates change, what's going to happen. I mean, obviously, either one or two things got to happen. Either the economy is doing better and quantitative easing's coming off the table, or that is a fundamental fact. But I can tell you from a technical perspective, something's going to give here. And while it seems a long time, people have not been watching some of these inverse ETFs. I think now is the time to start taking a look at them. QID, another inverse ETF that's off of the NASDAQ 100. Interestingly enough, while prices there have made newer lows, but not substantial newer lows, and all we are waiting for is a trigger, but currently you can clearly see that we are starting from a longer term perspective, developing even on a shorter term perspective. We've made lower lows over the last 6 weeks, and over the last 6 weeks we're making higher lows in this momentum indicator. So it is a cause for concern. Even the inverse ETFs are showing something unique, and I think that might be a good way to take some protection. Some of these are optionable and pathetic at that, because they haven't been, no one's in them, no one's using them. But this is the XBD, the broker dealer. The XBD, in times of slowdown, we've already seen a situation arise in the broker dealer sector. If you ever heard the phrase "selling may go away," right? And if this is kind of one of the rough patch of the market and volumes start to decline, then exchanges start to lose volume, trading firms start to lose volume, and trading firms make money either selling products or commissions. And so at this point in time, we've seen a situation arise. We've gone from trend, and now we're in this little consolidation factor here. And when I look at this, I go, wow, is this the time of the year that maybe possibly we could see this market go from trend, and this is an extension getting ready for a breakout? Possibly. I mean, you know, it is possible. That is a pattern. It's, you know, people look at wedge formations just for that reason. So if it does break out, yeah, it's arguable that A, B, C, then the extension of that measurement move is going to be somewhere close to, on the XBD, 250. You know, it was there back in 07. Sure, it could get there. But could it get there this time of year after it's already had this rally without any more sideways or possibly a retest of the lows one more time? And I think that the momentum indicator, at the very least, is kind of giving a flash warning that the market's kind of tired, even in this sector. So again, I'm just looking at, and someone would say, well, you're looking at too much stuff. And to me, I don't think I am. I think what I'm looking at is a lot of confirming indicators, and now I'm just saying, well, I don't have the resources to trade everything. I'm not managing a fund. I've got to pick the best trade out for my equity. And so with that said, I think perhaps looking at the weakest link of the chain is, of course, the Russell, the small caps. And if by, say, Thursday we get through the Fed FOMC, the meetings with Janet Yellen, we get through the beige book, et cetera, closer to the end of the week, if we're up here and we don't see an arguably appreciated advanced decline, I'm more in the camp of, yeah, I think it's time to, as they say, sell high maybe. And so if we do get one more peak rally up in here, I think it behooves us to take either some credit trades in on premium on any further strength to the upside in the S&Ps for either A, September, not August. I don't know if August will get you through a lot of the earnings season, but for directional trades, I'd be looking for some puts, as I talked about, or some credit call spreads in specific markets. I would look at that, or start pricing out, as I said in this here. Start pricing some put options using September or even October expiration, because some instruments don't list September, so they have August and October. And if those are your choices, you go with October expiration in some of the stocks in these sectors entering period of weakness. So hopefully that did give you some decent information. And of course, you can follow what these low close doji, these stocks within these sectors are all looking like. With that said, that concludes our planning and scanning for Monday, July 14th, and should get you through as next week we will be on our seminar at Seas Cruise. The seminar that I'm referring to down here in Florida can be found on the website, and once again, I will share that with you guys. If you go to personsplanet.com, tab says seminar right there, and it's a 2-day seminar event in Florida, and there is the information, and You can find everything you want right here. It's at the Marriott Singer Island Beach and Resort. Sunday, October 12th. Monday, October 13th. And we include breakfast. We feed you. It's just a very nice, an incredible event. So we look forward to seeing anyone that's interested. See the date.